Good morning, remisers and clients. Welcome to today's 11:15 morning call. I'm Joshua Tan, Head of Research. Today we'll be going over the usual market strategy, and we will be featuring Wilma. Okay. The debt ceiling opera continues. Last week, we've had a series of near deals, all of which have failed. The first proposal was between the House Republicans and the President, whereby the President actually rejected House plans to raise the debt ceiling for 6 weeks because the time frame was just too short and was entering the critical festival holiday spending period. And so the President was advised by his economic advisors that it was a pointless extension of 6 weeks because we'll be back to where we are again in a very critical time. So I think the signal from the White House is that a deal has to be done by the 17th. The Republicans tried to do another bill. This was done by Senator Collins that was offering to increase the debt ceiling and the shutdown by repealing a tax on medical devices and means testing for health insurance. But this was rejected by the Senate Democrats and the President as it was an akin to a Trojan horse on the Affordable Healthcare Act. And I think the President is pretty clear that he does not want that side of policy to be touched at all. So now we're back to a third round of negotiations. This is between Senator Reid and McConnell, the Majority Leader and the Minority Leader. And these two have dealt with each other for many, many years, over 20 years already. And so they are used to dealing with each other. I think this is the first time that they're meeting since the crisis escalated. So people are the signals tends to be hopeful, that they can broker a deal which can pass the Senate and then be sent down to the House of Representatives. I think if you read reports, Washington Post, New York Times, there's a lot of hot and cold on this. Some House Republicans from the House of Representatives are thinking that are having a negative view on the Republican senators, that they're trying to do a deal, that they're weak, and they're trying to do a deal with the Democrat leaders and ram a bill down Congress's throat, in a sense. And so I would have to say that never say never, right? Might the U.S. default. My own sense is that things are not going very well. If we get a deal, markets will chug along business as usual. And this bull run, in our opinion, is not over yet. We have reiterated this many times, but if we don't get a deal by the 17th of October, I think the repercussions are unknown. Will markets be so forgiving as the U.S. Treasury pays debt obligations first but defaults on non-debt obligations, right? That is basically what will happen on the 17th of October, where the Treasury will have to start prioritizing what it pays and does not pay, right? I think in human history, there have been moments where silly decisions have been made by people in power, and unintended consequences have resulted from obstinance. So I think it would be wise to rebalance portfolios right now. Of course, if we have a deal, then there's going to be upside. If we don't have a deal, then there will be downside. So I think rebalance your portfolio that hedges both ways. If you held too much risk, then maybe raise some cash. Okay. In general, I think in a worst case scenarios, stocks, bonds, and commodities will not be the place to be, and gold and cash will be preferred. So raise some cash just in case. Other than that, macro conditions still suggest the same old, same old. And as you can see, we've put a big disclaimer of sorts. KV scores assume that there's no extraordinary fallout due to the US default. Okay, we're still positive on equities. We think they're an overweight, but the US is starting to look stretched, whereas China remains an attractive proposition, and I think Singapore looks positive as well. So we have a call to long China with an ETF, 83188.HK. I think all the stars have basically lined up for China. We have improving macroeconomic fundamentals. We have valuations bottoming out at very low 9 times PE already. And on the technical stance, we have a weekly double bottom, and Kenneth will take you through the technicals again. And I think the uptrend is continuing there. So I think long China is a good one, and it also has the addedness of being a market that is generally shielded from capital flows. All right, so I think in the event of a U.S. default, most equity markets will be affected, and I'm not saying that China will not be affected, but it could be the least affected. Right, that is the A-share market, okay, which you can proxy through the ETF 83188. We're still positive on commodities because we have a improving macroeconomic fundamentals outlook globally, with a specific call to long oil service sectors using a sector ETF OIH. We're maintaining an underweight on gold, right, which we have held since last year, and I think the call continues that the prospects for gold remain bearish, right? Generally, the U.S. economy is improving, the trade deficit is narrowing. Actually, even the budget deficit is starting to narrow in the U.S., despite the fact that they still need to raise the debt ceiling for old policies. All right, right now the debt ceiling is not actually to raise debt for any new policy going forward. It's basically what Congress, Senate, President have all agreed on before, okay, which is why this whole thing is a bit ridiculous, because it is basically, if you've already agreed on all these old policies, then you should raise the debt to finance it, okay, but basically Republicans want to use this anyway to gain more territory on their terms. And we have a underweight on bonds in general and U.S. Treasuries, especially because on improving U.S. fundamentals. Okay, I'll move you on to Kenneth right now. We'll take you through the market analysis.
Morning, everyone. Here's Kenneth with the market analysis for this week. Okay, so as an update, looking at the FTSE All World ex-US index, it's still bullish. Not only have we penetrated through this multi-year resistance, we've actually managed to keep above it with a bullish candle. And of course, we mentioned a few weeks ago that we do have a stronger relative strength between this index versus the S&P. So this bodes well for ex-US indices. Okay, now an update on gold. Okay, this was our call since the 4th of October. I mentioned that we were in this consolidation pattern, but we were still bearish on the longer term. Okay, and then I mentioned these two levels to look at, and essentially a break above 1400 would be short-term bullish, and a break below this level here, 1300, will imply further downside. So this week we have gotten price has actually penetrated through this 1300 region for gold. So that means that we believe that yes, there should be a short-term downside, probably to around between 1200 to 1250. Okay, it's short-term bearish. We're also long-term bearish as well, by the way. Okay, one of the reasons why we believe you're long-term bearish is because this 19% surge up by gold was not accompanied by any excitement, relative speaking, with gold miners. GDX is actually a gold miner index, and I took the relative strength between gold miners and gold. And as you can see, during this surge up, right, there was really no excitement in the gold miners, and that's why we maintain our market stance that embedded within this bullish move is actually is actually quite weak. Okay, to corroborate that notion further, here's another chart showing how that as this bronze colored line is the gold price, spot price, and the blue color line is essentially the Fed balance sheet. So the more the Fed does QE, the higher the balance sheet, the amount increases. And in general, that correlation of increasing QE and increasing gold price had stopped just this year. So this also corroborates the notion that there is a real weakness in the gold market, as gold prices has not been increasing even though the Fed balance sheet has been increasing. Okay, a quick update back on the industrial sector. We mentioned this on the 19th of September. 19th of September, we talked about a retracement from this high to 45.5 to 46. So quick update, yes, 1 month later, we did hit our 46.0 target. And last week, we hit our 45.5 target. And as you can see, it rejected and rebounded off. So we did end up between our 45 and 46 point target with a nice gap up and a move up here. Okay, so this corroborates a short-term up move in industrials, and you can see also the stochastics have also turned. So short-term wise, we believe yes, industrials should continue going up. This is barring any extraordinary fallout from the US debt ceiling and or default scenario. Okay, so if nothing extraordinary happens, if we get some sort of positive resolution, we believe there will be a short-term move up. Okay, and if there's a short-term move up in industrials, that will also correspond to a short-term move up in the S&P 500. Okay, so short-term upcycle in play. Okay, for industrials. Now going to the S&P 500, we mentioned that this would be the support zone. We've hit the support zone. We consolidated inside it. Okay, finally we bounced off here, which is this ascending triangle pattern, which I mentioned last week. Okay, now based on the short-term up move from industrials, this is my probability target. So of course, no one can tell the future, but I have to give what I feel is the most probable scenario. So my most probable scenario, barring any extraordinary circumstances, is that there will be a short-term up move that will at least hit the top of this ascending triangle. Okay, the breadth indicators are actually confirming this move. So I see that this is quite possible to hit the top of the ascending triangle. Okay, the McLaren has also gone above it's the equilibrium point. It's now positive. So this kind of affirms this move. Okay, and the top side resistance right at this moment is 1750. So I believe this move is highly probable. Okay. A quick look at the sector glances, and you can see for all the different sectors, I know it's a little bit hard to see, but you can see for this week, essentially all of the sectors have gotten a bounce. So it's bullish across the board for all sectors. Okay. Okay. Sector trend update. You can see that industrials is still the leading sector in the S&P, and that materials and info technology is continuing to lead basically, and energy is lagging behind, but it's improving. It's going to get into the leading sector probably in a couple of weeks. Okay. So all this corroborates where we think we are between stage 4 and stage 5 of the market cycle. Okay, however, now that I've mentioned that the S&P and the industrial sector has a short-term up cycle, I want to give you a more intermediate guidance, and I believe that there is a lot of weakness inherently building up in this extended move here. So the bottom chart here is actually the chart of the New York Stock Exchange. Okay, as you can see, we all know it's been on an uptrend for quite a while. Okay, this breadth indicator on top is actually the NYSE bullish percentage index. So this actually measures the total amount of counters in the index itself, the percentage of how many of them have a bullish configuration as to a bearish configuration. A bullish configuration means a breakout from the point and figure chart. In layman's terms, it has a breakout configuration. So in other words, the point is that if you are reaching higher highs for your index over here, as in the case from the bottom, you should expect the number of stocks in the index to also reach higher highs or have a breakout configuration. And as you can see, for a big portion of the year, for 6 months, that's not been true. Prices have been continually reaching higher highs, but the number of stocks that are in the bullish configuration have been going down. So this shows you, even though the index price has been going up, right, but the number of counters have not confirmed this move. So this shows there's weakness building up in this index or in this system. Okay, and the longer this diverges, right, the longer it is, the greater the probability of a bigger correction. Okay, case in point, you can see a very big example over here. 2011, you see how price had consolidated in a range here, but while prices were consolidating in a range, you'll see that the number of stocks in the bullish configuration had been dropping. It diverged, and you can say it preempted actually this correction move over here. Okay, so we're starting to see a bit of that right now. You see the same thing in the bullish percent Dow Jones Industrial Index. The previous chart was the New York Exchange. This is the Dow Jones. Same thing. Prices have been rising, but the bullish percent index has been dropping. Same for the S&P as well. Okay, so what does this mean? Okay, so what's the conclusion? Now, barring a fallout from the debt ceiling and all that, okay, this is my most probable scenario. Short term, we're going to go up. It's probably going to hit the ceiling, and I think the coast is actually clear for the price to follow this ascending triangle for maybe 2-3 months. Okay, I expect it to follow. However, eventually the price has to break out of this ascending triangle. The question is whether it's going to break up on top or at the bottom. So based on the charts I just showed you, the evidence to me tells me that when this ascending triangle finally breaks, it will probably break out from the bottom. And when it does, it should be a more major correction. A correction is probably bigger than, say, this one over here. Okay, so when this finally does break, the ascending triangle, I think the target could probably be at least to 1550, which is down here, when it finally breaks. However, I do believe that macroeconomic conditions, where we are in the business cycle, and the short-term technicals will give it enough to actually follow this ascending triangle and grind up perhaps for the rest of the year. Okay, so that's where we are right now. Okay, so short-term is probably great, but now, when it does break down this ascending triangle on downside, whether that's just a correction, a major correction, or a start of a bear market, we'll only know at that time. So as for now, just know there is inherent weakness in this ascending triangle. Okay. In any case, we still believe that we are here. This is between stage 4 and 5 of the business cycle, where energy should be leading soon, but not yet, and that's where we are. And when that happens, that usually corresponds to the top of the stock market cycle. Okay. The market relationships are the same essentially for last week. We had a bounce for bond prices because it's the first time that this multi-year trend line was challenged, so we expect this bounce. Okay. Dow Jones World Index broken past resistance and is keeping above it. GSCI, Goldman Sachs Commodity Index, consolidating in this this triangle pattern here, and we are biased to the upside when this triangle actually breaks. Looking into the index fund itself, we mentioned last week that this is the chart from last week, and we mentioned that we are still technically in an uptrend and we are still at support. Okay, and we will keep to our stance unless this price is broken, or then when this bottom triangle size is broken, from this week we see that there has been a rebound. So in other words, our thesis is still standing at this point. If you're in this trade, our target price was $37, and the very conservative cut loss price is 32. Although this level should be the ultimate cut loss point if the price breaks down from there. Okay. All service sector, our thesis still remains. We are broken past our support line, resistance line here, and we are still above it. Okay, so this trade is still on. Target price 52. Cut loss price, if you have one, is 44 at this point. You can long this with OIH. This is the oil service sector ETF. The market analysis, once again, we believe we're here. US Treasuries, we've been through this chart. Okay, So right now that we've broken 2125.0, it's possible. We've already hit our target. I mentioned last week that the target was 126.0 to 126.5. We've hit that target and we bounced now. So now we got to see whether price can hold above this level here to remain bullish. If it breaks here, then we have case to go bearish on bonds. Okay, Shanghai index in this case. All right, we believe based on macro view that this is a potential bottom for the China market based on great valuations as well. And so essentially, here's the double bottom that we think we are at. And presently, we now have a configuration, and we have recently once again challenged the 200-day moving average. So this is good for our case. The more times that the price actually challenges the 200-day average, increases the probability of breaking above it. So this does corroborate with our bottoming thesis at this point. Finally for the STI, okay, from 1st of August, we mentioned there will be a retracement to the blue zone, most probable pattern. So we've had that. Okay, we hit the blue zone right in the middle of it. We surged up, and finally where we are is like this. Okay, I've drawn a couple of channels here for you to look at, and here's where I'm giving once again what I think is the most probable scenario, barring no extraordinary circumstances due to the U.S. default. Okay, if the U.S. Has a positive resolution to their default issue, then I believe that the stage is set for a rally that could last for the end of the year. Okay, and based on retracement targets and where I see resistances at, I believe it could form a pattern that's roughly like this, that could take it back up to roughly 34.30. Okay, now what would nullify this projection is if the price falls back into this bottom channel. If it falls back into the channel and stays below it, that will basically nullify this pattern. What will confirm this pattern is a break from this last week's high over here, or rather Friday's high, 31.80, or rather this level over here. So this candle has to break. Price has to break this candle and subsequently break this resistance over here. Breakage of both of these things will more or less confirm this move over here. Okay. So just to summarize again, assuming no fallout, overweight. You can still overweight equities, right? And we believe there's a short-term move up, even though on the S&P itself, right? We believe that ascending triangle was going to break on the downside in probably maybe 2-3 months. That's the approximate time frame. Okay, and this is only an approximation. Okay, China looks like a continuation move. You can long China, overweight commodities, underweight gold, and underweight treasuries. Although short term, it could be bullish. Okay, thank you. That's it for market analysis, and I'll pass you to Nicholas, who will talk to you about CPO price outlook.
Hi everyone, today we'll be talking about CPO price as well as the counters that we favor within the agriculture space. Let's first take a look at the demand side of the equation for CPO. We can see that Malaysia palm oil inventory started to rise in September to 1.8 million tons, 7% above the previous month's 1.7 million tons level on seasonal factors, though this is still 7% below consensus forecast. Stock levels have remained below 2 million tons for the 6th consecutive month, which we believe is supportive for CPO pricing. Exports seem pretty robust as the numbers rose by 6% year-on-year to 1.6 million tons on a higher demand from India, the largest importer of CPO. In addition, cargo surveyor Intertech recently reported a 17% year-on-year growth in CPO exports for the month of October for the first 10 days as compared to the previous year. We suspect that the buying could partly be due to stocking up from India ahead of the Deepavali festival season in early November. That said, we still believe that the stock levels should continue to rise over the coming months as palm oil production typically peaks in October-November period every year. Taking a look at the supply side of the equation, Malaysia September CPO production declined 5% year-on-year to 1.9 million tons, but continues to grow for the 7th consecutive month by 10% month-on-month as we enter into the seasonally high production period. In addition, cumulative year to September production this year is still 4% higher as compared to the previous year, indicating that biological slowdown has a less impact on Malaysia plantation estates as compared to its counterparts over in Indonesia. On the other hand, okay, if you look at the figure on the right, we can see that CPO production over the Indonesia in second Q this year is slowing down due to the palm tree stress following previous year's bumper harvest. One of the main reasons why tree stress is more pronounced over in Indonesia as compared to Malaysia is because the trees in Indonesia has an average age of has a younger average age as compared to the Malaysia plantations. Hence, they are more prone to seasonality and weather impact. We believe that the lower growth in Indonesia should also provide support to CPO pricing in the near term, in the near to medium term. After seeing the supply and demand side of the equation, we also have to consider the substitutes of CPO. Based on USDA projection in September, we estimate that the stock to usage ratio of global edible oils, including palm, soybean, rapeseed oil, etc., in 2013-14 is 14% versus 12.2% last year. The rise in stock to usage ratio indicates supply alleviation for global edible oils, in particular for the soybean crop, as the production is expected to jump 5% to 282 million tons this year and early next year due to bumper harvest from both US and Brazil. Hence, soybean prices will likely be dampened in the second half of this year and first half of next year, dragging down cereal prices as well. This, in our view, could be one major factor capping CPO price recovery despite the low stock level inventory over in Malaysia itself. In addition, CPO is currently trading at $160 per metric ton discount to soybean oil from a peak of more than $300 per metric ton, which is way below. This is way below its historical average of $205 per metric ton on the due to lower soybean prices. Thus, we think that this is no longer CPO to soybean discount is no longer a catalyst to CPO demand going forward. So on, despite the weaker CPO production from Indonesia as well as favorable biodiesel blending mandates from both Malaysia and Indonesia recently, we believe that CPO prices will remain muted at least for the second half of this year and early half of next year, mainly due to three main reasons. One is the steady production from Malaysia itself. Two, the anticipated higher supply of global vegetable oils such as soybean and rapeseed oil, which are substitutes of CPO. And third, weaker India rupee against the US dollars. As you can see, India rupee has depreciated over the past few months against the US dollar, and this has a great impact on the imports of CPO from India itself. All of this coupled with the seasonally peak production period over the next few months would cap any upside recovery on CPO prices in the second half of this year. In our view, we believe that it's too early to buy pure upstream plantation stocks, as the sector is still lacking positive catalysts. Hence, what we recommend to clients right now is we continue to like Wilmar for its mid and downstream exposure in the agricultural space. Allow me to walk you through 5 main reasons why we should invest in Wilmar itself. First, the vertically integrated business model. Wilmar's business structure is vertically integrated, spanning the entire value chain from origination, processing, and transportation to branding, merchandising, distribution of a wide range of agricultural products. In terms of operations, Wilmar's business activities comprise 3 main segments. First, plantations. Second, merchandising and processing. This includes palm and lauric oil, oilseed and grains, as well as sugar. And third, consumer packs. With this highly integrated business model, we believe that Wilmar will enjoy a high degree of cost competitiveness, which is supported by skills of economies of scale, operational synergies, and logistical and distribution advantages, and superior market intelligence. This is something that is more upstream focused peers like Good Agri and Fish Resources lack in. Second, the global integrated agribusiness. Structured as an integrated edible oil play, Wilmar extracts profit margins across all value chains, where each division is positioned as a profit center, in addition to obtaining operational synergies and cost efficiencies. Wilmar has established an extensive sales and distribution network in disseminating its palm and lauric as well as oilseed and grains products in the global market, especially in key markets in Asia itself. These capabilities are not easy to replicate, or at least it would take some time for its competitors to break into. This creates a natural barrier to entry and competitive advantages for Wilmar to maintain its strong franchise in its global edible oil market, in our view. Leveraging its extensive network, we believe Wilmar would be in a favorable position to seek new business opportunities in new markets and related industries across the globe. Third, its exposure to promising markets. Wilmar's business is concentrated in fast-growing economies with a large population bases in addition to low per capita edible oil consumption. In fact, it has strong exposure to growing end markets, with China and India representing 51% of its revenue last year, while another 26% of total revenue generated from Southeast Asia itself. We believe the strong exposure to these markets could benefit the company through increases in the consumption of edible oil, migration from unbranded to branded edible oil, as well as growing population bases. This is in line with strong GDP per capita growth, which is translating into growing consumer affluence and is supported by robust economic growth in these countries. Even though China, India, and Indonesia's edible oil growth consumption has been increasing over the past few years at a CAGR of 5 to 14%. Consumption per capita remains low, implying sound long-term growth fundamentals going forward for Wilmar itself. At the end of 2012, we estimate that edible oil per capita consumption averaged around 24.4 kg per annum in these 3 countries itself, 46% lower than the 45.2 kg in developed markets like US, Europe, and Japan. In our view, we continue to see Wilmar as a close proxy to Asia's growing food needs. Fourth is its limited impact from weak CPO prices. Wilmar's diversified business profile makes it more immune to the current low CPO prices. Plantations account for merely 23% of the group's profit before tax. The lower CPO price this year has resulted in a 30% year-on-year drop in plantation earnings for the first half of this year, but it still remains profitable. In fact, based on our estimate, every 10% drop in the CPO price merely decreases our earnings estimate for Wilmar by about 2.5%. On the other hand, this benefit is palm and lauric business due to the lower fixed stock cost, which in turn results in a margin expansion. As you can see in the figure below, CPO price is negatively correlated to palm and lauric margins over the past 5 years. In other words, whenever CPO price is low, palm and lauric margins tend to go up and vice versa. Last but not least, it's crushing margins normalizing. While overcapacity and price volatility in negative crush margins and losses for Wilmar's oilseed and grain division in first half of last year, we see that normalizing trends have started as the division continues to be profitable for four consecutive quarters. In addition, China's back-to-back soybean crush margins showed meaningful recovery over in the third quarter this year, indicating improvement within the industry as a whole. However, we see that despite this, we see that there's an increase in the soybean imports into China since June this year as well. In fact, year-to-date, soybean imports has increased by 4% year-on-year to 41 million tons. This in turn could lead to a lower domestic soybean price going forward, which is one of our concern here, hence depressing Wilmar's oilseed and grains division's margin going forward. While its flour and rice processing businesses continue to show growth and near break-even levels, they present costs for the oilseed and grains division as well. Hence, overall margins are expected to remain slim in the coming few quarters, and longer term, we believe that the sustainable margins for oilseed and grains is between $5 to $10 per metric tons as the industry gradually works its way out of the overcapacity issue in China. This is Wilmar's financial in brief. We continue to believe that $3 is a good support level for Wilmar's share price itself, given that top management bought Wilmar's stocks at around $3.18 last year. Wilmar also did a share buyback at $3 in second half of last year as well. And most importantly, we also see that currently Wilmar is trading at -1 standard deviation of its long-term average of both P and PB ratio, indicating good valuation for indicating that the current valuation for Wilmar is undemanding. Hence, all in all, we feel that Wilmar is still a good buy, and we strongly encourage clients to, go in before the valuation gets better again. Here's a brief outline of the Wilmar and its business segment, investment merits, and risk as well. Thank you for tuning in to our webinar this week. Any questions? Okay, with regards to your question on Noble Group in terms of commodity prospect, well, the region that Noble is exposed to, okay, one of the main reasons why Noble is still having difficulties over at its agricultural product segment is because they have exposure in the Brazil side, and that is causing problem for them. This area is something whereby Wilma is not exposed to. Wilma's exposure is highly concentrated over in Asia itself, in particular India, China, and Southeast Asia, and that's why we are strongly recommending Wilma as a good commodity play currently in this point of time.
Hi, there is a question on the telco sector. Currently, we are still positive on the three telcos, as mainly we are seeing data monetization gaining traction, and this mainly comes from customers upgrading to higher tier data plans, and also Singtel has increased its data access charges. StarHub will also be expected to increase next year. So we are still having a positive outlook on the telcos.
Yep. Hi. There's a question on soybean wheat. Anyway, this is Lucas covering the real estate sector. Soybean wheat is currently trading at about 7.5, 7.8% yield. The thing about it is we're actually quite bearish on the industrial sector as the real estate sector. We believe that based on the strong HGD, that demand for our export will actually go down. That's one. And also, in addition to the strong HGD, we feel that the industrial space is actually facing quite a bit of challenge. We actually do feel that the rental may actually see some weakness going forward, especially when the rental reversion we can see some tenants moving out, and also because of neighboring countries, industrials are actually proving more competitive as compared to ours. So we do not really have a very positive view on the soybean wheat, and the lack of a cornerstone investor may also is like a vote of no confidence. So, yeah, downcast outlook.
Hi, this is a question. Okay. Here's a question on, could you explain the 5-phase cycle chart that I showed earlier? Okay. So while our analyst is pulling up data on Wilma and Nobel, let me just answer this question first. Okay, let me go to the appropriate slide. Okay, I know many viewers have heard me quite a few times, but I will just do a quick one. Okay, so basically, there are two charts to look at when it comes to talking about the phases of the business cycle, and this is the first one. Okay, so a typical idealized business cycle And I like to reiterate the word idealized because every cycle is different and it's usually not ideal. But it's a good baseline to draw a reference from to frame your thinking. Ideal business cycle has 6 phases, and as follows here. Now, this line in the chart itself is just a measurement of the economic level, okay, of the business cycle. So this is not the stock market level, okay, it's the economic level. So essentially, when you are underneath the equilibrium line, your economy is contracting, and when you are above the equilibrium line, your economies are expanding. Okay, so it tells you that in the early phases of contraction, when you finally start contraction, right? Um, After some contraction, the Fed wanting to stimulate the economy, right, will basically decrease interest rates to stimulate the economy, and that's why bonds would typically bottom out and start to rise up in price. Okay, after stimulation for a while, the market will forecast that in a couple of months' time the economy will start recovering and stocks bottom out as well. So this should be your March 2009. Okay, if you want a last cycle reference, the bottom of stocks occurs at the most negative level actually, where the second derivation of the economic level actually starts to improve. Okay, we're still in contraction, but there's an improvement, and this is when stocks bottom out. Finally, as we're getting closer to expansion, commodities, the economy actually really starts recovering. Commodities go in price. This will be the bottom of commodities. Okay, finally, after we get to expansion, okay, if the economy starts to overheat, then the Fed has to um, increase interest rates, and they do so by selling down their bonds, and hence this marks the top of the bond market. Okay, after a while, this recall of stimulus will cause the economy to actually slow down as well. Okay, and the anticipation of that will cause the market to start to discount that, and this is the top of the stock market. Note that the top of the stock market doesn't come on when the economy contracts. It actually occurs before the economy actually contracts. Okay, because the stock market always forecasts, tries to preempt what the actual economy is doing. Okay, and then subsequently in the final phase, commodities start to go down. Okay, so where we think we are right now is here. We think we are here where you already have economies recovering. We've seen the recovery data in the US and Eurozone. So we believe we are mid to early in expansion phase. And we also think that bonds are starting to show weakness. And that's why we think we're in phase 4. Okay, so in phase 4, there's a few things that you have to take note. The first thing to take note is at this level, you really shouldn't be looking to long bonds. You should be thinking of shorting bonds for the longer term. Okay, you can long stocks because stocks only start its bear market in phase 5. Although we admit that we're close to the end. Okay, so you can long stocks although we're close, especially where the US market is concerned. Okay, Asian markets are still, in our opinion, undervalued. So there's more upside. At the same time, you can still long industrial commodities. Now, if you choose to long stocks, right, there are certain sectors that are favored in phase 4. Now, which sectors are favored? Let's go to the other chart. Now, it so happens that if you are in phase 4, this is the sector rotation model. And essentially during phase 4, these are the sectors that are favored. You have industrials, basic materials, and you're moving into energy slowly. Okay, so these are the ones that are favored more than the rest at this point of the phase. And one thing to note is that when energy starts taking the lead, okay, when energy is really favored and takes the lead, is a leading sector in the S&P, that's a big sign, one of the indications that the top of the stock market might have occurred. Okay, which makes sense because when there is heavy inflation and commodity prices start going higher, energy prices will also go higher, and that's why the energy sector will do well. But at the same time, increases of commodity prices and energy prices will put a damper on the economy, and hence there'll be that might trigger a bear market in stocks. Okay, so I hope that answers your question on the business cycle.
Okay, there's there's a question regarding what recommendation I would give for Wilmar versus Olam. Well, the thing is, it's very hard to compare both companies, even though they are both supply chain managers. Wilmar is in a business where it has huge exposure over in Asia itself, and they have a whole new, a whole deeply integrated supply chain, where basically no other supply chain managers has. Olam itself has different exposure. It has only about 25% over in Asia itself, and they have about close to 45% exposure over in America. It's kind of a more diversified company in terms of geographic location, and the business segments that they are in is also different. They do consumer agricultural products. They also do industrial products. So it's really hard to give to compare both companies. What we are recommending now at this point of time, because of the CPO exposure, is Wilmar, because Wilmar has a great percentage in terms of revenue that's generated from a CPO production. And Olam itself, they don't really have a significant percentage exposure over in CPO. And that's why we're not recommending, and we are not covering Olam at this point of time. You want to talk about your stuff?
Hi, there's a follow-up question on why there are people shorting the telco counters. Okay, generally, telco stocks are regarded as dividend stocks, and we think that this may be due to more investors favoring the growth stocks under current market conditions. But despite that, we still see growth for the telco counters, mainly on its mobile segments, as we see data monetization gaining traction, which will contribute to rising ARPU, and hence it will lead to growth in its mobile revenue.
There's a question on what could be the effects on CPO pricing if there is a US default. I think if there is a US default, it's probably all bets are off on things on risk assets like stocks and commodities, industrials, even agricultures. But I think and of course U.S. Treasuries itself and generally bonds would be not a good place to be. I think in the case of a default, I think you would probably want to hold as much cash as possible, and there is the chance that gold may surge. Well, it's a scenario that I think few of us can actually really get our heads around, because almost everything is benchmarked to the U.S. Treasury. And I think, it's very hard to give certain advice in such a case, but I think if that happened, it would be worse than Lehman, worse than 2008 and 9. It could start off very slowly, though, because it doesn't mean that on the 17th of October, the U.S. Treasury would default on all their bonds. Basically, they would start prioritizing payments, and they would prioritize debt obligations first, but then that would mean they would have to default on other things, right? Like basically non-debt obligations, Social Security or military contracts that they owe money on, or stuff like that. And there would be implications anyway.
Hi, question on the dividend yield on the telcos. Currently, the telcos the dividend yield is about 4 to 4.5%.
Hi, there's a question, and the question goes: is OUE going to sell their commercial building assets? Currently, they have actually made an announcement saying that they're exploring the idea of listing their commercial assets. So whether it will be successful or not is anybody's guess. The follow-up, there's a second part of the question that's asked: why are people selling OUE right now? I think previously for them, they actually give out a certain amount of special dividend after they give out quite a sizable amount of the amount that they raise as special dividend. They only retain about 500 million out of 478 million out of 660 million for the listing of their OOE hospitality trust. And currently, right now, within a short period of about a month, about 2 to 3 months, they are spinning off another asset. So I think some people are actually a bit cautious about how are they going to deploy their cash that they have on hand, and whether is there any more value accretive asset projects or development that they are able to acquire as well. So that may be something that the investors are being a bit watchful about. However, having said that, I think that their listing was quite successful previously, and this time around there may be there are reasons to show that they are quite strong, and the assets that they're going to list are actually performing very well right now. They're actually spinning off at almost the top of the valuation. So, yep, I think there's a potential special dividend coming along if they are successful, and the company still looks strong. We're actually having an accumulate call on it right now. Yep.
Okay, we have a very good question. And the question is, how long will this phase, okay, this is a business cycle question, the question is, how long will this phase for last? And I think this is a question that most people should be asking, and I think it's very important. And the reason why, the answer is the reason why we also are doing this business cycle slides every week. Okay, how long will phase 4 last? The thing is, to answer this question, it is not time specific. It is actually event specific. It is event driven and not time driven. Okay, what does it mean? Okay, I cannot tell you how long phase 4 of the market cycle is going to last. But I can tell you what things to look out for to know when it is over. And that's why we have to keep monitoring every week. Okay, how do you know it's over? A few things. Phase 4 is usually over when, one, there is problem with inflation. And when there's problem with inflation, the energy sector should be outperforming. So one, if the energy sector starts to lead all other sectors, that's a sign or a hint that phase 4 could be over. Second, for phase 4 to be over, you need continued bearishness for bond prices. In other words, if we see that the long-term trend for bonds have finally broken down, that would be another sign that phase 4 is also over. Okay, so right now I'm just going to list 2 events that we should look at right now. What I feel is the more important ones. One, when inflation becomes a problem and energy sector starts to outperform every other sector, and when the treasury bonds start to sell off again. So these are the 2 things that we look at. So now the treasury bonds have bounced off a support, and we would like to see when we see the treasury prices break down the support, that particular long-term support with conviction, that will basically give us more reason to believe that bonds have already started their bear market, which means phase 4 will be ending very soon. Okay, so these are the 2 things that we have to look at when we look at the business cycle. Okay, what is your definition of energy stocks? Okay, well, if I'm using this based on this sector rotation model, right? When we put down the word energy here, we're actually basically referring to a bunch of stocks which are tied in to energy and inflation. Okay, in other words, companies that would do well when there is inflation, which would essentially mean more upstream players like your oil majors, those companies that actually own a lot of commodity assets. Okay, rather than downstream, it's more upstream. Okay, of course, within the energy sector itself, you can't long all energy. Okay, although this is good for all energy, but every energy sector has its own individual risk. So, coal has its own risk, nuclear has its own risk, crude oil has its own risk. So you still need to be a bit selective when deciding what you want to invest in terms of energy sector. But in general, when we say energy sector, we mean basically that you should see rising crude oil prices, for example.
There's one question with regards to the counters in Singapore market which are considered material and energy stocks. Right, and in Singapore, in the Singapore space, for our oil and gas sector counters that belongs to Singapore's listed companies includes Keppel Corp, Sembcorp Marine, as well as the oil and gas service companies like Ezion and Ezra. We are currently having a accumulate recommendation for both Keppel Corp and Ezion, and a neutral rating for Sembcorp Marine and as well as Ezra. Ladies and gentlemen, thank you for tuning in to our webinar this week. Hope to see you next week. Thank you.